Day trading is an incredible business. It offers freedom and unlimited potential. But let's be honest, it can also be incredibly dangerous. The market doesn't care about your hopes or your dreams. It is a battlefield where capital is the ammunition, and if you run out, you're out of the game. That is why the best traders, the ones who last for years and build real wealth, are not focused on hitting home runs every single day. Their primary focus, their number one job, is simple but powerful. Protect their capital first. Everything else comes second. This is the foundation upon which a real trading career is built. Many new traders get this backward. They chase big wins. They see someone on social media with a massive green day, and they want to replicate it instantly. This is a recipe for disaster. The real game is not about getting rich quick. It is about compounding your skill set over time. You protect your money so you can stay in the market long enough to learn. You build your skills through deliberate practice and disciplined review. Only after you have a proven process do you begin to slowly, carefully grow your size. This essay gives you a simple, practical system you can use. It focuses on survival, on finding repeatable patterns, and on achieving steady, sustainable growth. Your trading success starts with your tools. You would not try to build a house with a plastic hammer, and you should not try to trade with subpar equipment. Good tools make your job easier, reduce stress, and prevent costly mistakes. The good news is, you do not need a NASA-level command center to start. You just need reliable, professional-grade gear that you can count on when real money is on the line. At a bare minimum, you need 2 monitors. 3 is even better. See your charts, see your order entry window. See your scanner all at once without frantically clicking between windows. Your internet connection is your lifeline. A dropped connection during a fast-moving trade can be devastating. You need a stable, high-speed primary connection. Have a backup, a mobile hotspot on your phone. Ready. Your computer must be fast and reliable. The last thing you want is your platform to freeze as you're trying to hit your stop loss. Don't cut corners. A dedicated trading computer, clean of extra software, is a smart investment. Beyond hardware, software is critical. Get a powerful charting platform with built-in scanning. Your job is to find opportunities. A good scanner does the heavy lifting and brings the best stocks to your attention. If you trade momentum, you need level 2 data and time and sales. That shows supply and demand in real time. Your mindset is the ultimate determinant of your success or failure. You can have the best strategy and the best tools in the world, but if your psychology is weak, you will lose. The market is an expert at finding your emotional weaknesses and exploiting them. To survive, you must operate with a set of unbreakable mental laws. The first law is to protect capital like Buffett. Warren Buffett's first rule is, never lose money. His second rule, never forget rule number 1. Your main job every single day is survival. A single catastrophic loss can wipe out weeks of hard work and, more importantly, shatter your confidence. You must avoid that one big loss at all costs. The second law is to be disciplined like a pro athlete. A professional basketball player doesn't just show up and shoot randomly. They practice the same free throw thousands of times until the motion is automatic. Your trading behavior must become just as automatic. Predefined entry signals, predefined stop losses, a predefined maximum daily loss. When you hit your max loss, you walk away. No questions asked, no revenge trading, no trying to get it back. The discipline to walk away is what separates professional traders from gamblers. It is a skill you must consciously develop. The third law is to concentrate like Icahn. Legendary investor Icahn doesn't buy hundreds of different companies. He finds a few high-conviction ideas and focuses his capital on them. As a new trader, your focus is your most valuable asset. You should not be trying to trade 10 different strategies on 50 different stocks. You will become a master of nothing. Instead, concentrate on just 1 or 2 A-plus setups that you know inside and out. It is far better to trade one perfect setup with precision than to spray and pray across dozens of mediocre trades. Quality over quantity, always. Risk management is not the most exciting topic, but it is the single most important one. It is the seatbelt that saves you in a crash. It is the foundation that allows you to build your entire trading career. If you do nothing else from this entire essay, follow these rules religiously. These are not suggestions. They are non-negotiable laws of survival. For a new trader, your risk per trade should be tiny. I recommend risking no more than 0.25% to 1% of your total account equity on any single trade. If you have a $20,000 account, a 0.5% risk is just $100. This feels small, but it keeps you in the game while you are learning. Your daily risk must also be strictly controlled. Your maximum loss for the entire day should be set between 1% and 2% of your account. Another powerful rule is the 3 strikes and you're out rule. If you have 3 consecutive losing trades, you shut it down for the day. Period. This prevents you from spiraling into a revenge trading frenzy where you give back all your profits and more. You must also have a maximum weekly loss, typically around 3% to 5% of your account. If you hit this weekly loss limit, it's a clear signal that something is wrong. You must stop, reduce your trading size, and conduct a deep review of your journal to find the leak. One of the most critical rules is to always use a hard stop loss. A hard stop is a live order placed with your broker that will automatically exit your trade at a specific price. A mental stop is just a hope. When a stock moves against you quickly, your emotions will kick in, and you will freeze. You will tell yourself, it will come back, as your loss grows bigger and bigger. A hard stop removes that emotional decision from the equation. It is your pre-committed line in the sand. It says, at this price, my trade idea is proven wrong, and I accept the small, managed loss. This is professional behavior. To enforce these rules, you must use proper position sizing on every single trade. The math is simple, and it keeps your risk consistent. The formula is shares to buy equals maximum dollar risk per trade divided by entry price minus stop loss price. Shares, bus, account risk, thus, entry price, stop price. For example, if your account is $30,000 and your max risk per trade is 0.5%, which is $150, and you want to buy a stock at $50.50 with a stop loss at $50, the distance is 50 cents. So your position size is $150 divided by 50 cents, which equals 300 shares. You cannot be a jack of all trades in this business, especially when you are starting out. You need to become a specialist. Pick one trading style and master it for at least 90 days. Mixing strategies leads to confusion and mediocre results. Give one style enough time and enough trades to learn its nuances, prove it works for you. Develop deep expertise in one specific area. Here are 3 distinct strategies. Pick the one that fits your personality and the current market conditions, then stick with it. The first edge, momentum trading. Best when markets are volatile, when news is driving stocks, when there's clear directional conviction. Momentum traders are like sprinters. They hunt explosive moves on high relative volume. Setups. Opening range breakout, where a stock breaks above its initial 5-minute high. Or high of day breakout on a stock with a strong catalyst. This style requires speed, decisiveness, and hotkeys for fast execution. Risk. Momentum can reverse quickly, so stops must be incredibly tight and always respected. Example, buy OT gaps up 30% on positive drug news. It consolidates for 5 minutes, then breaks the opening range high at 10.20 on massive volume. You enter long at 10.22, hard stop at 10.05. Take partial profit at 10.50 and again at 10.75s. The second edge, mean reversion. Best on quiet market days, choppy market days, or range-bound days with no clear trend. Idea: extreme moves away from the mean tend to snap back. Amateur traders roll out of bed and start clicking buttons. Professional traders follow a structured, repeatable routine every single day. This routine prepares them mentally and strategically for the trading session, just like a pre-flight checklist for a pilot. Your routine is your defense against emotional decisions and careless mistakes. It ensures you are operating at peak performance when it matters most. The day starts long before the opening bell with your pre-market preparation, which should take about 30 to 60 minutes. This is where you set the entire tone for your day. Your pre-market routine is your strategic planning session. First, you check the overall market trend by looking at the futures for the S&P 500 ES Nasdaq NQ. Are we gapping up, gapping down, or flat? Identify the key levels on SPY/QQQ. Second, you run your scanners to build a small, focused watch list of 5 to 10 stocks that are in play for the day. These are stocks with a catalyst, news earnings, or a technical breakout. Third, for each stock on your list, you mark the key price levels on your chart and create a plan. What is your plan A setup? What would have to happen for you to take a trade? Define your no-trade conditions, such as choppy price action, low volume. The first 60 to 90 minutes after the market opens is typically when the best volatility and volume occur. This is go time. During this period, you must be laser-focused. Trade only your primary A+ setup, the one you know inside and out. This is not the time to experiment or take a flyer on a setup you are unsure about. Scaling your trading size is how you go from making a small side income to potentially life-changing wealth. But if you do it wrong, it's the fastest way to blow up your account. Scaling is not something you do because you feel confident after a few good trades. It is a systematic process that you earn through proven, consistent performance. Think of it as a ladder. You cannot jump to the top rung. You must climb step by step, ensuring each one is secure before moving to the next. The first phase, phase 1, is all about consistency over profit. Here, you trade with the smallest possible size. Your only goal is perfect execution of your plan. Can you follow your rules for 20 straight trading days? Your P&L is irrelevant at this stage. Once you have demonstrated that you can be disciplined, you move to phase 2, edge proof. This is where you prove that your chosen strategy has a positive expectancy. This isn't based on a week of trading. You need a statistically significant sample size. I recommend a minimum of 200 trades. After 200 trades, you analyze your journal data. A business owner doesn't risk the entire company on one risky venture. They manage their finances, track their performance, and make calculated decisions. Your trading account is your business inventory. Your job is to keep that inventory safe. When you lose everything in one bad day, you cannot learn, you cannot practice, and you cannot improve. So, your first and most important goal is to be here tomorrow. Protect your capital first. Practice your edge. Then, and only then, do you earn the right to scale your size and your profits. This is the path. You must build 3 core assets to succeed as a trader. Think of these as the pillars of your entire business. First is your edge, which is a specific, repeatable setup that gives you a statistical advantage in the market. You need to know exactly what you are looking for. Second is your execution. This is your ability to enter and exit trades quickly, calmly, and without hesitation, following your plan perfectly. Third, and most important, is risk management. These are the hard and fast rules that keep you alive long enough to get good. Lose one of these pillars, and the entire structure comes crashing down. You are not paid for being right on any single trade. You are paid for flawlessly executing a positive expectancy system over hundreds of trades. Your feelings are irrelevant. Your gut instincts are irrelevant. Your predictions are irrelevant. The only thing that matters is whether you followed your plan. Did you enter where you were supposed to? Did you place your stop where you planned? Did you take profits at your target? Did you stop trading when you hit your max loss? Your job is to be an excellent employee of your own trading system. Focus on perfect execution of your process, and the profits will eventually take care of themselves. But remember, the 7 deadly sins you must avoid at all costs. Trading without a stop loss, averaging down on losers, trading too big, revenge trading, over-trading and chop, constantly changing your strategy, thinking one hot streak makes you an expert. Your next step, a 14-day build plan. This is not theoretical. You can start this on Monday. Days 1 through 3. Choose one style. Momentum, trend pullback, mean reversion. Read about it. Watch videos. Decide. Days 4 through 7. Define your rules. Write down 2 specific setups for that style. Max loss per trade, max loss per day. Days 8 through 14. Execute and journal. Trade with tiny size. Your only goal is to follow your rules and journal every single trade with a screenshot and notes.